For decades, silver has occupied an uncomfortable space in institutional portfolios, dismissed as volatile, cyclical, and ultimately subordinate to other assets. That perception has shaped positioning, pricing models, and even internal risk language. But something has shifted quietly enough that many missed the first signal. Historically, resistance levels in silver weren't just technical markers, they were psychological ceilings, reinforced by years of failed attempts and fast reversals. Each rejection trained desks to fade rallies and treat strength as temporary, yet the most recent move didn't behave like the ones before it. Behind closed doors, dealers began noticing that selling pressure thinned where it normally surged. Orders that once absorbed momentum weren't appearing on time, and the usual retracements arrived late or not at all, raising questions no one was ready to voice publicly. At the institutional level, price action is only half the story. The other half lives in inventory flow and hedging behavior. Subtle changes there suggested participants were no longer eager to part with metal at levels previously considered generous, hinting at a recalibration still underway. Early indications pointed to a disconnect between paper positioning and physical response. While derivatives activity followed familiar patterns, the underlying material wasn't circulating with the same urgency, creating a tension that pricing models struggled to reconcile. More quietly, some desks adjusted language in internal notes, replacing short-term trade framing with longer holding assumptions. That kind of shift rarely happens without pressure from somewhere deeper in the system, pressure that hadn't yet surfaced in public data. What unsettled seasoned observers wasn't the breakout itself, but the absence of the usual reflex to push it back down. When a market stops obeying its own history, the question isn't how far it's moved, but why it's no longer responding the way it used to. What made this phase different was how quickly conversations shifted away from charts and toward logistics. When price stops respecting resistance, desks start asking where metal is actually moving, and the answers coming back were incomplete. In prior cycles, strong price moves were accompanied by visible redistribution. Metal left vaults, changed hands, and reappeared elsewhere, but recent flow reports suggested something closer to consolidation than rotation, a detail that didn't align with standard breakout behavior. Some market participants pointed to routine explanations, seasonal demand, or positioning noise, yet those explanations failed to account for one detail. Bids remained firm even during periods when liquidity typically loosens. That firmness implied conviction rather than speculation. On the hedging side, behavior grew uneven. Certain producers appeared less aggressive in locking forward sales, while some consumers delayed expected coverage, a combination that only makes sense if both sides are reassessing near-term price assumptions. What drew attention internally wasn't volume, which stayed within familiar ranges, but the distribution of that volume. Trades clustered differently across time windows, suggesting participants were waiting rather than reacting, a subtle but meaningful distinction. Clearing data offered limited clarity, yet it reinforced one theme. Positions were not unwinding the way they usually do after a sharp move. The absence of forced adjustments hinted at balance rather than excess, an uncomfortable signal for models built on mean reversion. As these details accumulated, the conversation shifted again, away from whether the move was sustainable and toward who might be unprepared if it was. That question lingered longer than expected, and it pointed to the next layer of concern. Attention then turned to the structure supporting the market rather than the price sitting on top of it. When resistance breaks cleanly, stress often reveals itself in funding and margin behavior, but early signs there were unusually muted. Financing rates moved, but without urgency. There was no rush to secure leverage, no scramble to unwind it either, suggesting participants weren't chasing the move, but accommodating it, a posture that doesn't align with speculative surges. Margin adjustments followed expected protocols, yet the impact was contained. Accounts met requirements without cascading liquidations, implying exposure had been sized with more caution than the price history would suggest. That restraint raised a different question. If leverage wasn't driving the move, what was? Physical accumulation became harder to dismiss, not as a headline narrative, but as an operational reality hinted at by slower turnaround times and tighter availability in certain channels. Dealers who typically rely on rapid turnover reported longer holding periods. Metal that would normally re-enter the market within days stayed parked, not withdrawn permanently, but not offered either, narrowing effective supply. At the same time, delivery preferences subtly shifted. Requests leaned towards specific forms and locations, adding friction that can't be captured in spot quotes, but matters when scale increases. None of this confirmed a structural shortage, but it complicated the assumption that supply would respond quickly if price advanced further. Markets can tolerate that uncertainty briefly, but not indefinitely. As these constraints layered quietly beneath the surface, the risk stopped being about price reversal and started being about availability, a transition that tends to catch participants off guard. Once availability enters the conversation, attention inevitably drifts toward the intermediaries tasked with smoothing those frictions. Their role is to make markets feel continuous even when they aren't, and recent behavior suggested that task was becoming less comfortable. Some dealers adjusted quotes not by widening spreads dramatically, but by slowing response times. That hesitation, subtle and easily missed, signaled internal checks being run before committing inventory, a sign of caution rather than confidence. Others leaned more heavily on internal matching, keeping metal within existing networks instead of sourcing externally. That approach reduces exposure, but it also limits transparency, masking the true tightness until it can no longer be hidden. Inventory disclosures offered little clarity. Reported levels remained stable, yet turnover ratios declined, indicating that what was held wasn't moving as freely. Stability on paper can coexist with strain in practice. In parallel, conversations with refiners grew more frequent. Not urgent, but exploratory, as if participants were quietly mapping alternatives before needing them. Those calls rarely happen unless optionality is narrowing. What unsettled observers was how little of this registered in public commentary. Official narratives stayed calm, framing the move as orderly, but internal messaging carried more conditional language than usual. That divergence between public reassurance and private caution marked a shift in posture. When intermediaries start protecting optionality, they're not predicting crisis, but they're no longer dismissing it either. The question then became whether this caution would remain contained or bleed outward, influencing behavior beyond the immediate circle that first sensed the change. The next signal didn't come from price or inventory, but from correlation. Silver's relationship with adjacent markets began to loosen in ways that weren't easily explained by macro headlines alone. Moves that would normally track broader risk sentiment started diverging. On days when related assets softened, silver held ground, and when momentum returned elsewhere, silver didn't chase it, maintaining a steadiness that felt deliberate. That decoupling forced desks to revisit assumptions baked into cross-asset strategies. Hedging frameworks rely on relationships staying within tolerances, and when they drift, risk calculations quietly degrade. Some attributed the divergence to temporary positioning distortions, but the persistence of the pattern made that explanation less convincing. Temporary effects fade, this one lingered. Flow analysis suggested participation was narrowing rather than expanding. Instead of attracting waves of short-term capital, the market appeared to be supported by fewer, more consistent actors, the kind that don't respond quickly to noise. That concentration isn't inherently destabilizing, but it changes the character of the market. Liquidity becomes less elastic, and reactions grow asymmetric, conditions that amplify small shocks. Internally, scenario analysis began incorporating less familiar paths, not extreme outcomes, but sequences where modest pressures compound quietly. Those scenarios hadn't been prioritized before. As correlation weakened and concentration increased, the margin for error shrank. The market didn't feel overheated, but it no longer felt forgiving either. By this stage, attention shifted from what was happening to who was noticing it. Awareness wasn't uniform, and that asymmetry mattered more than any single data point. Larger institutions appeared slower to adjust, constrained by mandates and review cycles that favor confirmation over anticipation. Their positioning reflected established frameworks, not the subtler signals emerging at the edges. Smaller participants, particularly those closer to physical handling, reacted differently. They didn't rush, but they adapted, adjusting terms and expectations in ways that suggested a longer view was forming quietly. This gap in responsiveness created a layered market. Price reflected consensus, but behavior reflected divergence, a condition that can persist for a time without resolution. What complicated matters was the absence of a clear catalyst. Without a headline trigger, adjustments stayed fragmented, making it harder to gauge when alignment might return. Risk committees noted the discrepancy, but struggled to act on it. Acting early carries its own cost, especially when evidence remains circumstantial rather than conclusive. Yet history shows that markets don't require universal agreement to move, only enough pressure in the right places. That realization began influencing how exposure was discussed internally. The unresolved question wasn't whether the shift was real, but how long it could remain uneven before forcing a broader response. What followed was a change in tone rather than action. Language in briefings grew more conditional, assumptions were framed with wider ranges, and confidence intervals quietly expanded. This wasn't caution driven by fear, but by uncertainty that resisted easy classification. When signals don't align cleanly, institutions default to flexibility, preserving options instead of committing to a single narrative. Stress testing began emphasizing timing risk over direction. The concern wasn't being wrong about where silver might go, but about when pressure points could emerge if conditions shifted abruptly. Operationally, that translated into smaller adjustments layered over time. Limits were reviewed, not slashed. Exposure was trimmed in places, increased in others, creating a mosaic rather than a decisive stance. Meanwhile, communication between counterparties became more frequent and less transactional. Check-ins replaced trades, a sign that participants were gauging sentiment as much as supply. This environment favored those already positioned to wait. Patience became an asset, and impatience a liability, reversing the incentives that usually dominate during strong moves. What made this phase fragile was its reliance on restraint. As long as behavior stayed measured, the system held, but restraint isn't a permanent condition in markets. The moment one segment breaks from that posture, the balance shifts, and the effects rarely stay isolated. The final layer emerged not through disruption, but through normalization. What once felt unusual began to feel routine, and that transition carried its own risk. When elevated levels persist without incident, vigilance fades, processes adapt, thresholds reset, and what was once monitored closely becomes background noise, even if the underlying dynamics haven't resolved. In silver, that normalization masked how much behavior had already changed. Dealers operated under new assumptions, hedges reflected wider tolerances, and availability constraints were treated as manageable rather than exceptional. This acceptance didn't signal confidence, it signaled accommodation. Markets can absorb a great deal when participants believe they understand the boundaries, but those boundaries hadn't been fully tested. The quiet nature of the shift made it harder to identify turning points. Without volatility spikes or visible stress, signals blended into routine activity. Yet beneath that calm, the same questions remained unanswered. How much metal was truly mobile? How quickly could supply respond if demand surprised? How would correlations behave under pressure? Normalization postponed those answers, but it didn't remove the need for them. It simply delayed the moment when assumptions would be challenged, and when markets reach that point without preparation, the adjustment tends to arrive faster than expected. For decades, silver has taught participants to expect reversals, to treat strength as temporary and patience as optional. That conditioning shaped behavior long after the conditions that created it began to change. What's unfolding now doesn't resemble a traditional inflection point. There's no single catalyst, no defining event that marks before and after. Instead, there's a gradual shift in how the market functions beneath the price, a reweighting of assumptions that once felt immovable. Dealers noticing new patterns aren't reacting to excitement, but to inconsistency. When historical responses fail to appear, confidence in old playbooks erodes, even if no alternative has fully formed. This is how structural changes often begin, quietly and without consensus. By the time they become obvious, positioning has already adapted, and the opportunity to adjust calmly has passed. Silver's break above long-held resistance isn't just a chart event, it's a signal that the market's internal agreements may be evolving, and that evolution rarely reverses cleanly. Whether this shift resolves through price, availability, or behavior remains unclear. What is clear is that the conditions allowing silver to be dismissed as predictable are no longer fully intact, and when predictability fades in a market long taken for granted, the consequences tend to surface where few are still watching.